Just loading up, I think.
Cool.
Okay, here we go. I think we're live now.
Right.
Just loading up, I think. Yeah, there we go. And I think it says a few people watching now. If you are watching now, just send a quick message to the chat at the side, just so we know you're online. Someone already has. If you guys want to pop your name and company in the sidebar and just introduce yourself to everyone else who's online, that could be a nice start. We've got Nohelia online.
Yay.
At the moment. And we will wait until 11 to properly kick off.
Cool.
Okay, we're at 11. I might give it another minute or two, Hannah,
Yeah,
because
sure.
we're still only on 9 people, and I know we've got a lot more than that signed up. So I think they're probably just joining. I'll just pop a message in the Slack and send out an email to check if anyone is struggling. I don't want to start too late because I know we've got a lot to get through. So I think we'll kick off, if that's okay with you, Hannah.
Yeah, no problem.
We haven't quite got everyone online yet, but I think as you start your presentation, I'll just follow up with people and see what's happening. But welcome to those who are online. If you missed me saying it just at the start a few minutes ago, just kick off by sending your name and company to the chat bar at the side. That's really helpful to us to know who's online, and also probably quite helpful for all of you guys to get a sense of who each other is. Some of you, this is your first kind of point of contact with the Funding Readiness Programme, so welcome to those of you. My name's Ariana, and this webinar today is going to take you through an introduction to crowdfunding. I am the one who has been emailing you, but I'm not the one who will be running that session. Today we have with us the lovely Hannah, who is going to be talking you through basically everything you need to know. And at the end, we will be sharing the link to book a one-to-one with Hannah if you haven't already done so or already had one even. And she can talk to you in a bit more detail about your business specifically and whether it's right, whether crowdfunding is right for your business in that session. So I think that will do as an introduction, and I'll hand over to Hannah.
Super. Thanks, Ariana. Hi, everyone. I'm just going to share my screen. Oh, sorry. It says the host has disabled attendee screen sharing.
1 second, let me fix that. Sorry, guys. Okay, try that again.
Yeah, that's working. Okay, so here we are. Super. Okay, yeah, thank you everyone so much for joining. I'm Hannah, I'm from the Funding Crowd, and we help businesses raise on rewards and equity-based crowdfunding sites. So today I'm going to be talking through, first of all, why would you want to use crowdfunding over traditional investment forms, so over angel, VC, or grant funding, for example. What crowdfunding model is right for you? So there are lots of different types of models. I'm going to be talking through the merits of all of them so that you can understand which one is right for your business now and which one could be right for your business in the future. Then I'm going to talk about the different crowdfunding platforms. So these are the websites that allow you to do crowdfunding, and there's different ones for each model. And then to get to the meaty stuff, I'm going to be talking about how you create your crowdfunding strategy. So once you've decided what model and platform is right for you, how do you make sure you're preparing your crowd and getting your campaign ready for success? And really, this is what it comes down to. So we're going to be talking through how to create a successful crowdfunding campaign. So to start with, why would you want to use crowdfunding? So a kind of story to illustrate this is Brewdog, which are one of the kind of success stories of crowdfunding. In 2007, James and Martin, the founders of Brewdog, were selling a crate of beer a day on a good day at their local farmers market. So they were selling this retro style beer. This was before the craft beer revolution in the UK. And really that's because Brewdog started it. And they were really struggling to sell anything. People just weren't really interested. And they were missing their payments on their £20,000 bank loan. So every month they were struggling to make the full payment. And obviously it wasn't really going very well. And it was quite close to, they were quite close to stopping Brewdog and not continuing. Then they found that there was a competition that Tesco had launched, which was trying to find the nation's favourite independent beer. And if you got either first, second, or third place in this competition, then you would get your beers on the shelves of Tesco's. And Brewdog won first, second, and third place. So suddenly they had this opportunity to put lots and lots of their beers on shelves all over the country in Tesco stores. So it was obviously really exciting. They also now had all these people that knew about their beers that hadn't before, that were really interested in buying them. So they thought, okay, well, this is a turning point, but of course we can't fulfill all these orders at the moment, and we don't have enough funds. So they went to their bank and they said, so we've got this big order that we need to fulfill, but we don't have any money. Could we get another loan? And the bank looked at their record of their very poor payment history on their £20,000 loan and said, no, sorry, you don't have the right credit history for us to give you another loan. So we're in this position where they had an obvious chance to change the trajectory of their business. They had traction. They had people that were following them on Facebook, reaching out to them, wanting to buy their beers, but they had no way to take advantage of that potential. So what they looked at was a then new kind of funding called crowdfunding, where they could offer equity in a percentage of their business to all the people that wanted to buy their beers, all the people that were already really excited and wanted to help them achieve. And that's exactly what they did. They launched on Crowdcube, and fast forward to now, where they have bars in 52 countries, including a few hotels, and they've used crowdfunding to raise £7 million from over 15,000 crowd investors. So what this shows is really the benefit of using crowdfunding and where it kind of plugs that gap in the funding landscape, where it really did come in handy for Brewdog. What we've been discussing here, though, is equity crowdfunding. And there are several different types of models beyond equity crowdfunding that I'm going to talk through now. So there is rewards-based, donation-based, equity-based, lending-based, and crypto crowdfunding, also known as initial coin offerings or ICOs. Now I'm going to focus in the rest of this presentation on the first three, on rewards-based donation and equity, but I'm going to quickly explain what lending and cryptocurrency, crypto crowdfunding is, just in case it could come in handy in the future. So lending-based crowdfunding is also known as peer-to-peer lending. And the process of participating in lending-based crowdfunding is very similar to getting a loan from a bank. You go on a website that orchestrates lending-based crowdfunding, such as the Funding Circle or Rate Setter, and you ask them for a loan. And that loan is made up of lots of contributions from the crowd. So instead of one entity, one bank giving you a loan and then taking the interest you pay on the loan is split between all those different crowd contributors. So that's peer-to-peer lending. And if you are interested in taking, or you're looking at taking on debts to fund your business, then lending-based crowdfunding could be a good option. The other one is crypto crowdfunding. So this really it was a bit of a bubble, really. A couple of years ago, it got really big at the same time that Bitcoin's value was increasing drastically. And the way it basically works is that, to give you an example, if you had an idea of a way to revolutionize the way that babysitters and parents paid money to each other, that a payment system for that, for babysitting, you might think, okay, well, in order to raise funds for this, I'm going to create a cryptocurrency called Babycoin. And in order to fund my business, I'm going to ask people to buy Babycoin with Bitcoin. And by doing that, you exchange the Babycoin, the cryptocurrency that you've created, for Bitcoin, which obviously is of higher value, and that's how you increase your funding. Now, if you Google the top crowdfunding or highest value crowdfunding projects, almost all of the top 10 will be crypto crowdfunding. It's a way of raising money really quickly, and it has raised astronomical amounts of money for businesses. But there is not much regulation surrounding it, and since that initial kind of boom, it hasn't really been used to the same extent, because there are now different kind of regulatory hoops to jump through, which doesn't make it as suitable. If you are looking at launching a payment system or anything within the cryptocurrency industry, it could be something to consider. But otherwise, I would say that it's something to look out for and be interested in, but not something to use to fund your business straight away. So that's lending and ICOs. More than happy to answer any questions on that, but now I'm really going to focus on the other three. And the reason I'm going to focus on these is because these are the ones where the likelihood of success is a lot less predictable. With lending based, you just apply for a loan, and if you're not successful, that's kind of the end of it. But with equity, rewards, and donation, there's a lot of work to be done, and that's what we're going to be talking about in this presentation. So rewards-based crowdfunding is when you offer a gift or a prototype of a product or an experience, and you pre-sell that gift to fund your business. So you might, for example, have a product that you're looking to bring to market, and you just don't have enough to get to production. So you sell prototypes, or you sell an early version as a pre-ordering mechanism, and then you have the fund you need to develop your product and then deliver to your customers. So Kickstarter and Indiegogo, which I'll be talking about a little bit further later, represent this type of crowdfunding. The second is donation-based, and this is essentially charitable giving. So Captain Tom's recent crowdfunding was obviously an incredible example of donation-based. And people are contributing because they believe in the cause and they want to support you with no expectation of return. They're just passionate about what you're doing. And finally, equity, which we've discussed. So you can buy equity of a company from £10, and instead of one or two people taking equity in your company, lots of crowd investors, whether that be your customers, your friends, your family, buy equity in your company to fund your business. So those are the 5 models. Now I'm going to talk about the benefits that each of these models offer. So all of them offer similar benefits. So all of the models offer a way to involve community in your growth. So if your business, and it's the case with most young businesses, they have a group of people around them that are really passionate about what they're doing, whether that be their friends, family, early adopters, people that you told the idea to start with. All these people have had a significant involvement in your growth so far. And crowdfunding is a way to involve them in a different way, connect with them in a different way, and help them share in your success as well as you grow. Doing a crowdfunding campaign is a way to raise awareness of your company and market your company in a different way than traditional investment methods might. So when you host a crowdfunding campaign, that's obviously public. It's on a platform that has regular traffic. You're exposing and spreading awareness of what you're doing. It's a way to attract new customers. So I see this a lot on equity crowdfunding. Some companies end up getting more investors than they had customers before. And those investors, obviously, having bought shares in the company, are much more interested in buying from the company. So it's a way to, in line with spreading awareness, it's also a way to attract new customers, attract new people to what you're doing. And finally, it's a way to test demand. So especially for rewards-based crowdfunding, if you have a product idea and you think, okay, well, I don't know if people are actually going to want this, I don't know if people are going to buy it, better to do a crowdfunding campaign before you've gone to manufacturing, which is very expensive, and risking that people don't buy it when it's in market. Instead of doing that, you can do it earlier, see if people are interested, see what comments people have about the product. And then if it reaches your goal, you know that there are enough people out there that are really interested and willing to buy your product. Specifically with equity, the benefit that crowdfunding offers above traditional investment is that you can accept investments from £10. Now, this is possible to do outside of crowdfunding, but the time and effort it takes to do this normally ends up being more than £10. So that facilitation that crowdfunding offers is a huge benefit. And by doing that, you obviously open up. You're able to accept investments from a whole different group of people that you never were able to offer that investment from before. So friends, family, early adopters can now own a bit in your company, whereas before they might not have been able to. For rewards-based, and I've touched on this as well earlier, it's being able to fund the product development journey way earlier than you normally would. So without crowdfunding, the process is to spend a lot of time developing a product, manufacturing it, getting it to market in the hope that it sells. But here you can accept orders before the really expensive part, which is the manufacture. And you can do that to test demand, see if people are interested, and onboard customers really early as well. And finally, for in donation-based crowdfunding, the reason you might use crowdfunding platforms instead of just having a donate button on your website, for example, is that you're able to access a kind of a new generation of funders, people that are interested much more in what the specific impact of what they're doing. They're interested in more transparency of where their money is going, and they're interested in more information about the project before they contribute. These are all the things that crowdfunding platforms facilitate. So so if you're a charity and you're interested in reaching that group, crowdfunding is a really good way to do that. So to give you an idea of the typical product that each of these models are suitable for, I've kind of put this together, but it's worth noting that especially for rewards-based, there is quite a range of different projects that work for this. So the kind of average raise on rewards-based is 50,000, but companies have regularly raised kind of 12 million plus, and also a lot of people fail and a lot of people get less than 10,000. So there's a huge range around this. But if you're trying to base which model you should go for based on the amount, then 50,000 is a good one for rewards. Normally rewards-based needs to be B2C, and that's really around incentivization. So donation-based, you don't have an incentive. Equity, you have equity as your incentive. Rewards-based, you have to have something that's not equity that people are interested in pre-ordering, interested in buying. And that's really where, if you're a B2B business that, for example, is an app or a web platform, it's hard to offer tangible rewards that people would want to buy. It is always the case that as much as people are generally more patient with crowdfunding platforms, they recognize that there's always going to be a longer waiting time. They still want to buy something that's tangible. And if you can't form a good incentive, then you might struggle with rewards-based crowdfunding. So that's really the big thing with rewards-based, whether you can create a tangible incentive for backers. For equity, average raise is about 500,000. So it's normally your first or second round of funding, normally after a friends and family round. This is really the first time you're giving a significant amount of equity away, normally. Both B2C and B2B businesses work well. So like A few B2B businesses have done very well on equity crowdfunding. I know one recently, which was it's like a machine that allows you to pour a pint in less than 10 seconds. I was interested in that. And it's a B2B business, so it sells to like event spaces and bars, but obviously for the consumer, it's easy to understand why that's beneficial to them as well, and why that's going to make a difference in the industry. So B2B businesses can work on equity platforms, but there needs to be you need to be able to communicate why your business is going to grow, why it's making a difference, because otherwise the general wider audience might not understand that. So B2C businesses work well, like breweries, food businesses, apps, always do well on equity crowdfunding. B2B does okay, you just need to be able to communicate that value for a wider audience. And finally, donation-based. For the average donation-based campaign, you're really looking at about 5,000. That's the kind of order of magnitude you can expect to raise. And even that is with quite a lot of work, because you're really having to appeal to people's altruistic side. They're not getting anything in return, so they really need to be passionate about your cause. And as a consequence, in general, you aren't able to raise as much. So that's worth bearing in mind. I think a lot of people do say kind of, oh, well, I've got a social aspect to my business. I could probably do donation based, and you might be able to, but you probably won't get the funding that you need to grow a business long term. It's more something that you might do for marketing or to get just a little bit of awareness about the social aspect of what you're doing. So I'm going to go through now the decision framework for deciding which model is right for you. It would be good if you had a pen or paper handy to kind of follow along. I'm going to go through both the rewards and donation one, and then the equity one, and then I'll put them both on the same slide so you can kind of view them at the same time. But if you'd like to follow along, this is the kind of decision process I go through with my clients to determine if they're right for the model, and if they are, when they'll be ready. So I've touched on this already. With rewards-based crowdfunding, the first question is whether you have a physical B2C product, so whether you already have that physical incentive. And you'll see projects like smartwatches, VR headsets, bags, urban mobility products do really well on crowdfunding, and it's those cool, innovative tech ideas that tend to do well, and they're all physical B2C products. So that's the first question. And what I'm going to go down first is the ideal path. So yes, I have a physical B2C product. What is the next question? Well, the next question is, do you have an existing network valued of at least 50% of your funding target? Now, this taps into one of the most important things that I'm going to say in this presentation. Crowdfunding is all about momentum. People only contribute in projects that they think are going to be successful, or they think that other people are interested in. And you can kind of understand this if you see a campaign and you think, oh, this is a really cool product, I really like this, I think it's really cool, but no one else has contributed, no one else has bought it, I wonder why that is. And there's that doubt there. And in crowdfunding, when you're not buying a product that exists yet, you're normally buying a product that's in prototype stage, that trust is vital, and any doubts about whether it's a good investment, whether it's a good contribution, will halt your pledges massively. So you need to bring in that momentum already. You don't want anyone to come to your page and think, oh, okay, well, no one else has contributed, so I'm not going to contribute. You want to tap into the opposite effect, where people say, okay, well, this is kind of interesting. And hey, like hundreds and thousands of people are loving it and talking about it, and they think it's great, so it must be good, so I'm going to buy it. And so you need to build that momentum early. And this is where it comes down to looking at your existing network. So do you already have a big Facebook following, or do you already have lots of customers? Do you have people that I know are going to contribute to my crowdfunding campaign? In which case, that's great. You'll be ready to launch within 6 weeks minimum. So you just spend those 6 weeks getting people aware of your crowdfunding campaign, getting your content ready, and then you'll be ready to launch, because you know you have those people ready to go. On the other hand, I'm going to go through the non-ideal path. So we'll go back to the beginning. If you don't have a physical B2C product, then you need to find a way to offer tangible value to backers without giving equity, because we're talking about rewards-based crowdfunding. To give you an example of what this might look like, I ran a campaign recently which was an urban farm. So they were growing plants hydroponically, vertically in this cave. And they obviously had this like big farm. They couldn't like give away a farm, but they could find different ways of involving customers without without giving away equity. And what they did was that they grew like little edible flowers and they sold them in little jars, and then they harvested some of the greens and they sold them. So they created tangible rewards despite not having done that before, to ensure that people would contribute to their campaign. If you aren't able to do that, however, if you can't find a way to really create a tangible reward, then the next question is, are you a charity or a social enterprise? Do you have a core social impact with what you're doing, and are you a not-for-profit? The key here is that it's quite difficult to raise and ask people to give money to your company if you're a for-profit company. So really, you can only you're only saying yes to this if you're a not-for-profit. And if that answer is no, then you're not right for rewards or donation-based crowdfunding. It means that you can't find a way to offer a tangible incentive, so people aren't really going to buy or contribute as part of a rewards campaign. And you're a for-profit company, which means you're going to struggle to accept donations, and people are not really going to contribute to you, despite if you have a social impact as part of what you're doing. So now I'm going to go back, and I'm going to come back to, do you have an existing network valued of at least 80% of your funding target? And in the vast majority of cases, the answer is no. As much as that's really ideal, if you have enough customers to be able to raise half of the funding that you need immediately, it probably means that maybe you're kind of using crowdfunding as a marketing tool as opposed to really fund what you're doing. So the vast majority of people I come across are at no. So they're at ready within 3 months minimum. So to emphasize this, you have a physical B2C product, or you have a way of creating tangible value, but you don't yet have that 50% funding target. You don't yet have the opportunity to build momentum, which means you need to spend 3 months minimum building momentum. And that's really what you've got to focus on, is growing your social media following, growing your online presence, getting people excited about what you're doing. So when you launch, you have that momentum that's building into your campaign. And then to go back, sorry, I've jumped ahead a little bit here, but to go back along this kind of non-ideal path. So if you are a charity or social enterprise, then you can use donation-based crowdfunding. That's an option to you. And if you do have a way to offer value to backers without giving away equity, then you come back onto the ideal path. So if you can find a way to incentivize with a physical product, then you're back onto this main section of finding that 50% of your funding target prior. So now we're going to move on to equity crowdfunding and whether equity crowdfunding is right for you. Now you may have heard, and this is a term used a lot by angel investors and within the investment landscape in general, which is the term traction. And equity crowdfunding, just as other traditional investment methods, depend on traction. And how you determine traction is normally from one of these 5 things. Do you have revenue? Is your revenue growing? Do you have big partnerships, or will you be forming big partnerships with big suppliers or similar companies, or potential exit strategies? What kind of people are involved in your company and surrounding your company? How many customers do you have? Is that growing? What's your social media like? Are you getting press coverage? And what's your team record? So normally, if you don't have the 4 above, but you're a team that has experience in building and exiting companies, then obviously that experience is just as significant in terms of dictating whether your company is ready to grow. And that's really what traction means, is does your company have the evidence right now to show that they're going to be growing, to show that the value of the company is going to increase and they're going to succeed? Because any investment in startups is risky, and you want to be able to show anyone that's taking this risk that their risk is mitigated by all these other great things that are going on in your business. So we're going to start with the ideal path again. Do you have a network valued at least 50% of your funding target? And we come back to this. So if you're able to demonstrate traction, then it comes back to whether you can build that momentum. Now, in rewards-based crowdfunding, this is more about having leads and having people that are ready to buy straight away. In equity crowdfunding, it's about having pre-committed investment. So this is a common misconception, is that crowdfunding is a replacement for angel and VC. It's normally not. Normally they go hand in hand. So the vast majority of the big equity crowdfunding campaigns you see, they'll probably have at least 30%, probably more, of their funding target already secured as pre-committed investment, And what that means is that an angel investor or a VC firm has committed to giving them investment at the same terms as their crowdfunding campaign prior to the crowdfunding campaign. So this means if you're offering the crowd a valuation of, say, $1 million, and you're offering them 10% equity, it means that an angel investor has already taken 5% of that equity at the £1 million valuation that you've offered. And then in your campaign, you'll have 50% already secured from the crowd, but it's actually secured from an angel investor. So this is another really important thing. If you want to raise on equity crowdfunding, you cannot ignore other traditional investment methods. You will have to be thinking of it as a partnership between both traditional and crowdfunding. Crowdfunding allows you to get your customers and your friends and your family involved, but you need that 50% or between 30 and 60% pre-committed investment to ensure you have the momentum to reach the rest of your target. If you do have that, then again, you can be ready within 6 weeks minimum. Now, to go back to the non-ideal path. So if you can't demonstrate traction right now, the question is, will your business's circumstances change in the next 3 months to allow traction demonstration? So do you maybe have a partnership that's in the pipeline? One of my clients was very close to onboarding Nike. They were an activewear e-commerce company. So they knew that, okay, we don't have Nike on board right now, but we will do in a couple of weeks. So we're going to be fine. We're going to treat this like we do have traction and we can prepare as a consequence. Or, you have some big press coverage coming out, or maybe you're just about to launch, so you're just about to have some revenue and some customers coming on. If that's the case, then that's great. If that's not the case, then this is the non-ideal path, and it means you're not right for equity crowdfunding. And that really means, in the context of equity crowdfunding, just means that you're not investable yet. You're not able to demonstrate that your company is going to be growing, which means that any investment in your company is just incredibly risky, and therefore it's unlikely that you're going to attract investment. You need to find a way to show that any investment, which is always going to be high risk, does have some opportunity to return, and that your company is going to grow and it's not going to fail. So if your business's circumstances are not going to change and you're not going to be able to demonstrate traction, then crowdfunding, which is a very public and unpredictable investment method compared to angel and VC, is not right for you at this time. Now, if your business's circumstances will change, then you can still do equity crowdfunding, but you're going to need a little bit longer to make sure that you have that traction. And then once you're able to demonstrate traction, then you need time to go out and get that pre-committed investment, and everything takes a little bit longer. But that's still an option. It will just take you a little bit longer to launch successfully. And to go back to the top, so this is really the path that most people take. So you are able to demonstrate traction, you're ready to get investment, but you don't yet have that pre-committed investment. You don't yet have that 50% of your funding target. So you're going to need a little bit longer. You're going to need 3 months minimum. So I'm going to give kind of 30 seconds for you to just kind of consolidate this and go through this if you need extra time. In the meantime, I'm just going to go through an example of how this might work. So one of the companies that I was speaking to recently was a company that had urban wind turbines that were about like this big, and you could put them on your balcony in an urban area, and it would be able to generate electricity from wind coming from all directions, so turbulent flow, so coming from up the buildings, from the sides, which is not possible currently with the big wind turbines you have. They need a lot of open space. So it's a really innovative idea, really innovative product. And they were, so to go back to the flowchart, they did have a physical B2C product. We move on to the next thing. They're very new. They didn't have any customers. They didn't have any social media following. So they didn't have their network valued at least 30%. So they're in this within 3 months minimum section. However, they did have equity to give away as well. And they did want to grow quite quickly. So they weren't interested in getting, maybe a couple of 100,000 from rewards. They were maybe more interested in getting kind of 500,000 from equity. So we went and looked at the equity flowchart. So they didn't have any revenue. They didn't have any customers yet because they hadn't launched, and they didn't really have any social media. They had a good team record. So several of the people on the team had exited companies before, and they had a few partnerships with big housing developments that were going to put their product as part of their building. So they were going to be making a huge number of sales there. So they had a bit of traction and they were okay. So we went on the yes, the ideal path. And again, we come back to, they didn't have 50% of their network. So again, they were looking at within 3 months minimum. And so that's just a quick example. If you do have any questions on this, feel free to ask at the end. But I hope that's given you an idea of what model could be right for you both now and the kind of time frame associated with that.
Guys, do pop that in the chat if you've done the flowchart now and you've got a result there, because it would be great to see what everyone has seen there and whether crowdfunding works out for people.
Would not be ideal if everyone's like, yeah, no, it's not going to work. Okay, so now we're going to look at platforms. So for rewards-based, there are 3 big ones that in the UK you should consider, and they all have very different aspects to them. So Indiegogo is really for products. You don't see many other projects really on Indiegogo. It's really all about design and tech, and they have a lot of tools to support product launch, but they're not so good for like publishing projects or community projects. Crowdfunder is excellent for community projects. So if you go on crowdfunder.co.uk, you'll see a lot of political campaigns, community projects, community-owned businesses using Crowdfunder. And it's a mix of equity, rewards, and donation, but it's most well known for rewards-based. Another good thing about Crowdfunder is that when you launch your project, you automatically submit an eligibility criteria to the Crowdfunder team, and they might match you up with some grants that they have available. So they're actually a signposter for different grants as well. Lots of local authorities give Crowdfunder money to distribute. So that could be quite good if you're a community or a social enterprise. And Kickstarter is kind of in between. So they started as a platform for creative projects like artists and poets and publishers, and they've expanded beyond that like significantly to also support design and tech and lots of different projects. But because of that, they're not really refined in the same way like Indiegogo is for product launch. It's more of it's a jack of all trades kind of platform. You can pretty much do anything on Kickstarter, but it means you don't always have the refined tools for certain types of projects. So those are Kickstarter and Indiegogo definitely have the biggest presence and the biggest traffic. Crowdfunder is a UK-based platform that is doing really useful stuff for social enterprises. So it's a good one to look at if you have any like a social impact or if you're a community-led business. For donation-based, the biggest one and the one with the kind of worldwide brand awareness is GoFundMe, and another one is Just Giving. There's not a huge difference between these platforms in terms of how they operate. Their fees are very similar. GoFundMe sometimes waives their fees for like medical campaigns. If someone needs to raise money for medical fees, GoFundMe sometimes waives the fees for them. Just Giving is set fees, but I think they're slightly cheaper than the average for GoFundMe. So I'd say that's the only real difference between them. If you did want to do any fundraising, have a look at the projects that are live on both and whether there are any fee waivers going on. But other than that, it's really kind of a personal choice based on the project that you're running. And finally, the main equity platforms in the UK, are Crowdcube and Seedrs. The key thing is that both Crowdcube and Seedrs are starting to accept foreign investment onto their platform, and also some companies external to the UK are launching. But in general, all of that stuff is still just developing. In general, you need to be registered in the UK, and you need to expect the majority of your investors to be UK based. So that's a big thing with equity. There are lots of other equity platforms worldwide, like there's lots in the US. So if you do have a network in the US, for example, you may want to consider an equity platform in the US. But I'm going to focus on these two because these are the ones that are most likely to be useful for you as UK-based companies. The main difference between them are 2 features on either platform that really dictate whether it's right for you. They're quite similar in terms of fees and in terms of the support they offer. But Crowdcube offers physical incentives that you can offer as part of your investment. And Seedrs doesn't, but Seedrs offers a secondary market. So I'm going to clarify what that means. So if, for example, you're a B2C company and you have lots of customers that are already buying your products, say you're a food business and you've got people buying your crisps and they love your crisps, it's sometimes quite hard to convert those people into investors. If they're just spending, 50p on a packet of crisps, then they're probably not that interested in paying £100 to invest in you. What Crowdcube allows you to do is offer incentives for different levels. So for example, if you invest £100, then you get a year's supply of crisps. And obviously that incentivizes your existing customers to invest in you, and it allows you to incentivize your campaign beyond just offering equity. So that's really good if you're a B2C company and you have lots of customers that you want to convert into investors. Seedrs has a secondary market. It doesn't have incentives, but it has a secondary market, which basically means that if someone buys shares in your company, they can trade them before you've exited the company. So in the case of Crowdcube, if you buy shares in a company, you're only likely to see a return if the company gets bought or if the company goes public. As soon as the company kind of cashes in its value, that's when you're able to cash in your shares. Normally that takes kind of a minimum of 5 years. So it's a long time to wait. On Seedrs, you can trade your shares earlier. So if you decide you want to sell them, or you see that the company's increased in value but it hasn't yet gone public or hasn't yet exited, then you can trade your shares with someone else on Seedrs. So that allows investors to basically kind of lower the risk of their investment a little bit, because it allows them to exit earlier if they want to. So those are the main two things to consider with Crowdcube and Seedrs. So now we've kind of covered the basics of how to choose your platform, how to choose your model. I'm now going to talk about strategy. So everyone is likely to be either at pre-crowdfunding or pre-campaign at the moment. And these are the kind of 4 stages. So the point of deciding whether crowdfunding is right, whether the model is right, is pre-crowdfunding. Then the next stage is pre-campaign, and this is the kind of 3 months or that time frame prior to your launch, and it's by far the most fundamental phase. It really dictates whether you're going to be successful or not. And so I'm going to focus the rest of this presentation on pre-campaign, because it doesn't matter what you do in the later phases. If you haven't got your pre-campaign right, you're not going to have a successful campaign. So how you decide to structure the effort of your pre-campaign phase is dependent on which strategy you should lead with. Now, there are 3 crowdfunding strategies. The first one is the big backer strategy. So this is when you lead with big investors and big contributors to fill up most of your round, so that you have that momentum and a lot of your target already secured, with the rest to be topped up by the crowd. So it just ensures that you have that momentum going in, and it ensures you're going to reach your target with a group of large contributors as opposed to lots of small contributors. The second one is the community-led strategy. So this is when you already have a big network of customers, friends, family, and you're pretty confident that you don't need to do much to convince them. They're probably going to contribute anyway. And because you have those numbers, you're going to fill your target with lots and lots of people that are really excited to contribute to your campaign. And the final strategy is the ad strategy. So this is basically if you don't have lots of people that are willing to contribute big, or you don't have lots of people, like a large group of people that are going to fill up your campaign from small contributions, then you're going to need to pay in order to get the traction and get the awareness that you need to get your target. And so that's the ad strategy. That's when you're using paid advertisements, normally on social media, to raise awareness of your campaign. So in order to decide which strategy is right for you, you need to examine your existing network. And this is looking, okay, who is interested in contributing to my campaign? Are they big backers? How many people are there? Do I have a big enough community to be able to get that 50% already? And if not, then maybe ads is right for me. So in order to decide your strategy, it's looking at who is currently engaging with your business. And this allows you to select your strategy ratio. So what's clear is it's not just one strategy. You have to have elements of all 3, but what strategy is most useful for you is the one that you lead with and the one that you put the most effort in. So to give you an example, I have lots of previous investors, high net worth individuals that want to join this funding round, but I don't have any customers or social media following. well, since that's the case, you're going to have to lead with your big backer strategy. Like about 70% of your effort is going to have to be spent on ensuring that those big contributors are excited by your campaign and they're ready to contribute. And then you don't have much of a community, so you might just engage a little bit of effort to make sure the people that know you, your friends and family, are going to contribute. And then you need to spend some money increasing the number of people that are engaging with your campaign. So you need to spend a little bit of money using ads. And then the second example is that I don't have much budget for ads, but I have lots of friends, family, Twitter followers, and a few of those could give bigger contributions. So they could be big backers. And so here you see the split here. So you would focus the majority of your time making sure that all those little contributors, that large group of little contributors, are excited by your campaign and are going to contribute. And that'll be 65% of your effort. Then you're going to spend 25% of your effort making sure that some of those people contribute more to get some big backers in your funding target. And then a smaller amount you might spend on just a small amount of budget to raise profile, but this is a lot smaller because your budget is smaller. So that is how you determine how to focus effort on your pre-campaign phase. Once you've done this, it's about creating your content to reach these people. So I'm going to quickly navigate to Crowdcube to show you what that looks like. So Crowdcube and Seedrs are very similar in their format. You have a big header image, if it loads, yeah. Big header image, profile picture, and then you have your key numbers up here, how much equity you're giving away, what your valuation is, and a kind of an executive summary with a few bullet points. If I go down, and you have a video here that's normally quite business focused, so it's just a description of your team. It's more of like an interactive version of your pitch deck, and you have your idea, so this is normally about 500 words. And then you have an introduction to the team. And finally, at the bottom here, you have your documentation, so your pitch deck. If there's any evidence of taking on debt or former equity investments, you also could include that. So that's equity crowdfunding. I'm then going to go to rewards-based crowdfunding to show you some of the content. So I mentioned big campaigns. I think this was something like the 17th biggest campaign of all time, raised £10 million. And it's a really good example of a well-orchestrated campaign from a content perspective as well. So rewards-based, you have your video is the main, kind of the centerpiece of your campaign. It's not just a description of your pitch deck, it's more of an advertising piece. So it's a lot more consumer focused, upbeat music, drone shots, all the stops. It's a lot more, a lot more interesting to watch than an equity video. And then as we go down, you'll see that there's a lot more media content on the pitch compared to equity crowdfunding. So you have, you've got GIFs here and like a small amount of copy, but nowhere near the 500 words that was on the equity campaign. Lots of eye-catching content, lots of videos, a lot more focused on it being easy to read and eye-catching and engaging in a different way. So I've gone through that. So yeah, just to summarize, rewards-based, so you kind of have these things that you need to tick off. Step 3 is that once you know, okay, so you have content ready, you have, you know what your key message is going to be, you know who you need to reach because of your strategy, then it's about planning and implementing the marketing strategy. So creating the marketing strategy normally has, for any marketing strategy, you have the kind of 3 core level things that you need to think about. Firstly, who are my audience? Well, we've already kind of gone through this. You would have already done this as part of planning your pre-campaign phase. So who are my investors? That's done. The next thing is, what do I need to tell them to convince them to invest or to contribute? And that's all part of your messaging and content work. So you would have already done this. The final thing is, how do I reach them? And this is really step 3 in this process. So what are the channels that I need to use? Do my customers love using Facebook? Do they love using Instagram? Are they more easy to reach on LinkedIn? These are the questions that you need to ask to make sure that you're using the right channels. And once you've decided which marketing activities are right for you and the way to reach the crowd and the right contributors, then you need to engage the crowdfunding funnel. So before your campaign has launched, how do you make sure that all those people that you might have contacted 3 months ago before your launch are still engaged with your campaign and still ready to contribute? Well, you need to build a pre-launch or pre-registration mailing list. And this is basically collecting leads. So you reach out on Facebook ads and you say like, hey, we're going to be launching soon. We'll offer you an exclusive discount if you're on our mailing list, and you put them on your mailing list so that when you go live, you can just send them an email and say, hey, we're live, go contribute now. And that's how you get that momentum coming into your campaign straight away, because these people that you've been engaging with and talking with over the last few months are now excited and ready to contribute, and you have that 50%, you have the momentum moving into your campaign. You should also be continuing these marketing activities while your campaign is live. But of course, once your campaign is live, the main call to action is not to sign up to a mailing list, but it's to contribute to the campaign. So to summarize, choosing your model and platform, we've gone through a few kind of decision-based processes there. It's really about what can you offer as an incentive, and whether you already have the traction and the momentum ready to launch, or whether you need to take time to build that. Once you know when and how and what platform you want to launch on, it's about looking at your network and understanding who are going to be the people that want to engage and contribute to my campaign, and which strategy is right. Is it the big backer, is it the community, or is it the ad strategy? And in what focus should I make each of those strategies? Then it's about thinking about what those investors want to hear. If you're talking predominantly to big backers, then it's really got to be about the impact that their money is having. If they're contributing more than kind of £100, they want to know that that's being spent wisely, and they want to know that they're making an impact with their money. So that's what you'd really focus your message on. On the other hand, if it's kind of a big crowd and you're asking just for kind of £5–10, then it's a very different set of messaging that you're using there. So thinking about that and creating the content to come along with it on both the campaign page, but also across your marketing channels as well as the next step. And finally, plan and implement the marketing strategy. So think about the channels that are working for you and create that pre-launch mailing list using the crowdfunding funnel, so that when you're ready to go live, you'll have lots of people that have already engaged with what you're doing and are already excited to contribute. And that's how you create a successful campaign. That's it from me. Ariana mentioned that there were one-on-ones to book. If you'd like to speak more about your company specifically, then feel free to book some one-on-ones on the link there. They have been going very quickly. So I recommend, if you do want to book now, because you want to make sure you get one if you're really keen to speak. Okay, there we go.
Thank you very much, Hannah. That was great. Much appreciated once again. As Hannah just said, the link will be shared along the slides after this webinar, and all of the slots have gone very, very fast on previous occasions. So do get on that. Actually, what might be helpful is if I get a sense from those watching now who after this webinar is thinking of booking a one-to-one. So please just put a note in the chat now, and then we can get a sense of numbers for that. So now we're going to move to questions for Hannah from you guys. We've had a couple coming in throughout, and we had a couple in advance, but if there are any more that have come up, now is your chance. Again, pop those in the chat and I will read them out. Okay, so starting off, we had one in, I think, well, the first one we had in was quite broad. How do you know if your project is suitable for crowdfunding? I think that you've covered that really in your presentation. I think your flowcharts are very useful for that. But if the person who sent that question and wanted to follow up with something a bit more specific, I'm happy to go to that. At what stage of the project would you look at crowdfunding? When would you recommend someone launches a campaign?
So in terms of when to consider crowdfunding and whether you want to use it, the earlier the better, really, because I've talked about the community strategy as one of the basically the cheaper options. If you already have an active and excited community, then crowdfunding is straightforward. And when you start community building is really the earlier the better. So the more that you're reaching out to people, the more you're posting content, getting people in a Facebook group, getting people on a mailing list, that can start as early as possible, and that will increase your chances of success for a crowdfunding campaign. In terms of stage of development, in terms of your business, if you're a product, looking at product development, in terms of when you really need to focus on crowdfunding, it's once you have a proof of principle prototype. So at that point, that's when really to start creating content. There's no point doing it earlier, because you won't be let onto the rewards-based platform. You need to show that you can create the product. And then also that's the point, obviously, when you'll need the money, because the next step is manufacture. So that's for rewards-based. In terms of equity-based, it's really all about traction. So if you can't demonstrate any of those 5 things that I mentioned, then it's not the right time to really activate any equity crowdfunding preparation. Once you do have equity crowdfunding, the next step is to see if you can get that pre-committed investment. If you can't find any angel investors that are interested, maybe they're saying it's too early stage, then that's also another indication that you're not right for crowdfunding yet. So yeah, equity is about traction, and rewards-based crowdfunding is about when your incentive is going to be ready, when that tangible reward is going to be ready.
Okay, thank you. The next few questions we had in advance, one was similar to the previous one about maturity of the company, and then about how you value your company. Kind of similar to that, someone asked, how do you value your existing network? Is there an average individual contribution number? I think that's probably not the case, but I don't know if you want to speak a bit, Hannah, maybe about also how you might pick how much to go for initially and what to add.
So in terms of valuing your company, that is like the question I hear the most in general within the startup space. Like it's such a difficult, the first valuation you make is a really hard task. There are a few tools out there that can help you. Like if you type in like valuation tool, you might find some tools that can help you value it, that will give you kind of a few questions on competitors and revenue and lots of different things that might give you a tool, but the main that might give you a valuation. But the main advice I give is look at competitors and look at other companies, what other companies' valuations were at when they were at your stage, to give you a number to start from, and then talk to people about it. Really, the only time your valuation is fixed is when someone invests at it. So you can go along and say like, oh, my valuation is like 12 million, but until someone actually invests at that valuation, that's not your valuation. So really talking to investors is the main way to really fix your valuation. And then the other question was about valuing your existing network. So I do.
Oh, she's just paused for me. Has everyone else had that as well? Sorry, everybody. I'm just texting Hannah now. One moment, everybody. Sorry about that. Okay, guys, Hannah says massive apologies. Her Wi-Fi has been very dodgy this morning and she's just disappeared for a minute because of that. But we're going to try and get her back on.
Oh, okay.
Hi.
Hi, everyone. I'm so sorry about that. I've been having troubles with connection all morning. What was I up to before I froze?
I think you were talking about valuing your network.
Okay. I feel like I was probably speaking for so long after I froze. Basically, it's a difficult process of really trying to predict what what individual people would contribute. There's kind of no hard and fast rule about how much people would contribute. If you've got a product and you know you're selling it for X amount and you think that someone will buy the product, obviously you can say, well, I expect them to contribute X, and then try and kind of add that up. But yeah, there's not kind of one single rule for that, unfortunately.
Okay, thank you very much. Let's try and get in a couple more. We've only got a few minutes before 12, but if it's all right with you, Hannah, we might go 1 or 2 minutes over just to try and cover the final few questions.
Yeah.
So we had a couple in about like types of projects for crowdfunding. Someone says, what type would you recommend for service-based brands? Like what type of crowdfunding? And a couple of other people have said, what about crowdfunding for capital-intensive projects or manufacturing? And crowdfunding seems to prefer kind of product-based businesses and not service-based. Do you have any examples of service-based businesses that did well on equity platforms? So I think that's all generally about the kinds of companies to go, what kinds of, you know what I'm trying to say, what kinds of crowdfunding to go for with different kinds of companies. I don't know.
So yes, B2C companies do better on both equity and rewards-based crowdfunding. That is definitely the case. It all comes down to being able to incentivize contribution. And sorry, actually, I've started on B2C. We're not talking about B2C versus B2B. We're talking about product versus service. So ignore what I just said. Service-based businesses have done well on equity crowdfunding. Most recent example is Free Trade, who offer an investment service. It's definitely possible. I would say only equity based. I wouldn't really consider rewards based. And really, the determining whether your business is particularly right is just all about incentivization. If you offer a service to consumers, and it's really easy to see why that service solves a problem in the industry, then there's no reason why you can't do crowdfunding. I hope that summarizes it. Feel free to kind of book a one-on-one if you want to kind of speak there in more detail. If that answer doesn't quite cover it, but in general.
A couple of people did ask, can you think of one particular example that did well? And someone else has also asked, is there a well done crowdfunding words this morning, guys? They're not great for me. Someone asked if there's an example of a B2C campaign that has done well that you would recommend they look into.
So a service-based.
Both a service-based example and a B2C example. I don't know if there's one of each, maybe.
B2C, there are tons. So yeah, Brewdog is one. There recent ones like Totem was another one. There's tons of B2C. I think if you went on Crowdcube and see this right now, the vast majority would be B2C that are doing well. So I would check that out. In terms of service-based, there's How Much at the moment on Crowdcube that's doing quite well. They've hit over 100% of their target, and that's a service to match tradespeople with homeowners. Free Trade is one that did really well recently. I think they actually broke records even during coronavirus, so they did really well. Free Trade is another one on Crowdcube. And there is very likely to be service-based companies already live at the moment. In terms of, historic examples, Free Trade is a really good one to look at. Also, Luggage Hero on Cedars is another really good one.
Nice, thank you very much. Okay, let's do one more question. What if your project is launched and your funding is growing, is for growing or including new features? How would you tailor your message? So how would you change your campaign kind of marketing depending on what stage you're at, I suppose?
So if you've already launched and sorry, can I clarify, is it that someone's circumstances of their business has changed, they now need to change their messaging?
They've said if your project has already launched and your funding they're going for this campaign to grow it and include new features rather than to get it off the ground in the first place. They'd like to know how you would change how you speak to people than if you were using the campaign to kind of start things off initially, as far as
well, I think it's completely normal of people raising investment to improve their MVP or increase new features, so that you wouldn't be alone in terms of that messaging. And if you need to change that from "we need your help starting up to, okay, we've got enough money and now we're changing features, then just say that, just be completely transparent about the state of your company. I think that's what's really valued on crowdfunding platforms, is that transparency with how things have changed, and make it clear why the features are worth investing in. So that's a big thing in the context of the needs of the investors. So if you're introducing features that are going to be really valuable to your customers, make that clear and say that why you're doing that, and that will really interest people.
Great, thank you. Okay, so we are at 2 minutes past 12. I think we will end it there because we haven't had many other questions in. So thank you once again to Hannah for the great presentation. And I hope you all have been inspired to book a one-to-one and find out more about how this could fit for your business and what kind of campaign might suit your business. I've made a note of everybody who said in the chat that they'd be interested, and we will be sending out the link to that along with the slides later today. So thanks very much for joining, everybody.
Thanks, everyone.
Bye.